I think the 75 basis point is pretty much baked in. And the big discussion now is on the December meeting, whether it'll be 50 or 75 basis points. But I think if we take a step back, the market's in a bit of a catch-22, because if we want earnings to stay stable, given the costs that companies are facing now, both wage pressures, other input costs as well, for them to pass those costs on is what's necessary for earnings to stay stable. And passing those costs on mean inflation.
They're telling us that they're going to hike. They're following what the market is pricing in. And the market still has another 175 basis points of hikes priced in over the next 4 meetings. And so ultimately, it doesn't seem like they're really slowing down much.
All eyes are on the Fed once more, as the new CPI report shows inflation has gone up month on month by 0.4%. This is despite the 75 basis point increase in federal interest rate. And year-on-year inflation is still up a very high 8.2%. Cathie Wood still thinks the Fed needs to cut down in hiking rates. It is a divergent option that many do not share, but what are her reasons? She talks about that in this interview. Another thing that is extremely high is the number of people that are yet to subscribe to this channel. Before you go on, click that subscribe button now. It would bring you much luck in your investments.
How can you be unanimous in your decision-making, you Fed board members, unanimous at the last few votes, when there's so much conflicting evidence out there? And yes, we feel as though the Fed is making a mistake here, and that, yes, high beta stocks, which would be our kinds of stocks, more volatile than the market, do get hit disproportionately. But something's happening now, and it's happening with Bitcoin as well, which I find very interesting. So our strategy bottomed intraday, the flagship, on May 12th. And the S&P and NASDAQ have broken below their lows. Last week, they broke below their last lows. We did not. Now, maybe I'm jinxing myself, and we will now. But our strategy has held up better since May. And same with Bitcoin. Same with Bitcoin after the volatility in May. It's held in much better. It hasn't hit new lows, successive new lows. It's in a range, much like our strategy is. During a bear market and towards the end of a bear market, our strategy starts outperforming. Why? There's a saying in our business that the new leadership shows itself toward the end of a bear market. It starts outperforming.
Last week was the best week for Wall Street since June of this year. Stocks had climbed in an unprecedented rally, despite the recent CPI report still indicating that inflation is still high at 8.2%. The Dow Jones, S&P 500, and NASDAQ Composite all gained massively. Some managers on Wall Street believe this bounce back is just due to recoil from markets getting oversold for so long. Investors must tread with caution, as experts believe that the rally may not be sustained. As we revealed in one of our videos last week, the banks are profiting immensely from the interest hikes, and this profit is begging to spill into their stocks. Goldman Sachs gained 4.6%, while JP Morgan appreciated by 5.3%. Oddly, tech companies are not benefiting from the upshoot in profits and share value. Telecoms companies and social media platforms are still underperforming. Cathie Wood has based her predictions on the stock market on its poor performance in September and the first week of October, when Bitcoin showed more stability than the S&P and NASDAQ. Before the recent rally, the NASDAQ had dipped to a 2-year record low, and the reason was the falling chip stocks. Cathie believes that falling prices would be a bigger problem than inflation if the Fed continues to tighten. She believes that this stability is a sign of the end of the bear market for Bitcoin.
The problem is the Fed here. And in the piece we wrote today, we said, please consider the conflicting evidence and at least debate. Talk about the risk of centralization. This is a massive risk because it's not just the Fed. It's not the Fed board members. It's probably one member, and that's Powell, who's insisting on unanimity in their fight against inflation. So what they've just done is raised interest rates 13-fold from 0.25 on the Fed funds rate to 3.25. And they're going to go to 4, we believe, on November 2nd. That's a 16-fold increase in interest rates.
How does that impact you directly?
There are strong indications that the Fed would be responding with further hikes, which would be more than expected before, as inflation is not slowing down enough. According to Cathie Wood, the hike is already too steep, steeper than that Paul Volcker imposed in the 1980s. From reports coming through sources from the Federal Reserve, another 75 basis points hike should be expected by the beginning of next month. This is coming at a time that the United States Conference on Trade Development, UNCTAD, is calling on the Fed to slow down on constrictive policies. The Philadelphia Fed president last week insinuated that the process of bringing inflation under control can sometimes be slow. There are already talks about rates going past 5% instead of the target 3.25% by the end of the year. If this is true, then we are far from the bottom in the assets market.
This has been associated with supply shocks every step of the way. COVID, supply chain, Russian war. It's hard to separate out. And I think the key here, and this is where I'm going to have the biggest argument with the people who really think inflation, the genie's out of the bottle. I believe the velocity of money now is going to start falling again. It actually peaked in 97, has been falling, falls at an accelerated rate during crises. And if the velocity of money starts falling now, that M2, it looks like M2 is going to come in below 3% year over year for September. If velocity is falling on top of that, that means nominal GDP growth is flat to negative on a year-over-year basis. That's a killer for companies' profits.
Cathie talks about velocity of money as a precursor to inflation or deflation, depending on the direction money velocity is taking. Velocity of money simply means how often the same money circulates in a system. Velocity is usually high when liquidity is low, as everyone has to depend on the low liquidity in the system to meet their demands. This would mean money would have to change hands much more frequently because of the high demand for scarce liquidity. High money velocity is an indication of high degree of inflation. Tom Barkin, the president of the Richmond Federal Reserve, seems to agree with Cathie that there is an inventory backlog that has to be cleared for the economy to rebound. This backlog, he said, was caused by the COVID pandemic and now aggravated by the Russia-Ukraine war. At this crucial time, you need to stay updated with every key movement in the market. That is why you should subscribe so you don't miss out on our next upload. Don't forget to give this video a thumbs up and see you next time.